Alright, so today's bank is Civista Bank Shares Incorporated. It's located in Ohio. I think they've got a presence also in Kentucky and Indiana. But it's a fairly small bank, maybe about $4 billion of assets, at least small for the publicly traded community banks. Typically in our population we've got somewhere between 5 and 18 billion-dollar asset banks, so a little on the small side. I think they've got around 40 something banks, but we can go over to the Yahoo Finance page and see a little bit more about the bank before we jump into the details. But as we've seen with most banks, we've had this trajectory of kind of up, down, and then it decides year to date, is it going to go up, is it going to go down? Looks like this bank has pretty much gone down year to date, but over the past few weeks it's had a pretty good run. So we've got a price earnings ratio of about 6.99. That's pretty low. That's an earnings yield of about 14%. So that's a really low price relative to earnings. So either there's some risks in the bank that make it be a cheaper price, or the earnings are just really good. But we'll find out once we dive into things. Pretty good dividend yield as well. The statistics page tells us the price to book ratio is about 0.66, so that's really cheap for the net assets as well, for the book value of the company. So we might have us a really cheap priced bank on our hands here. Return on assets about 1%. That's pretty average. So is the return on equity. So it's making good money. So for whatever reason, the price seems to be a little bit lower than the average bank, and in the face of the earnings and the book value and stuff. So let's dig in and find why that might be. But we might have a pretty reasonably profitable and reasonably priced bank. So let's see. All right, so cash of about 50 million. That is not very much at all. It's about 1% of the assets, and that's a really small amount. We typically see somewhere between 4-6% of the assets is cash, so really small amount of cash. Hopefully they've got some securities or loans that are maturing soon that will give them some more cash, but securities about 600 million. That's about 15%. That's pretty average. 15% of the assets on the balance sheet. So that's pretty average. Loans of about 2.8 billion, and that's about 75%. So it's about average too, a little bit on the high end of things. So we've really got a very average asset side of the balance sheet. The goodwill is a little bit higher than we normally see. It's about 3%, but while most of the time we see about 1% is goodwill, so maybe they've been really acquisitive in the past, or paid a little bit more than fair net value of the net assets in their acquisitions. Anyway, everything on the asset side of the balance sheet seems very normal, if not a little bit more allocated toward loans than to cash, but not egregiously so. So I would think that the interest income is probably about average, about the same as for an average bank. And we'll see if that's the case once we get to the income statement. But for the liability side, we've got about 700 million of non-interest bearing deposits, and that's about 20% of the liabilities. So that's about average. We typically see somewhere between 20 and 25% non-interest bearing deposits, so that's great. We want as many non-interest bearing deposits as we can get. Of course, in this environment, there's a lot of migrating to interest earning deposits as the customers, now that the interest rate's a little higher, customers find it a benefit to put it into interest earning accounts, if not accounts outside of the bank, different types of securities or investments, right? So that's good that they've still got a lot of non-interest bearing deposits here, but it does look like they're a little bit more favored toward debt than to interest bearing deposits. The debt is about 14%. So if we add the FHLB advances, subordinated, other borrowings, it's almost 500 million, which is about 14%. And that's about double what we would see for most banks. So they're a little bit more allocated toward debt, which of course is a higher cost funding source. So for that reason, we might see a little bit higher interest expense than for the average bank if we're a little more allocated toward higher cost funding sources. But it's not a whole lot of money here, right? So it's probably not egregiously high interest expense, but more kind of close to average. But we did see that they're a little more allocated to loans, at least on the high end of a range probably. So maybe the higher yields on the loans would offset some of the higher yields on the debt, right? Anyway, so let's go to the income statement to see if that's the case. So we've got about 50 million of interest income. That's about 5.70% of assets, which is a pretty good amount. Yeah, that's a really good amount. The loans are yielding 6.13%, which is a really good yield as well right now. So they're doing really good on the asset side of the balance sheet. Even the securities, it looks like, are yielding about 3.5%, which is really good as well. The past couple banks that we've looked at, it's been in the twos, which is really low. So at least this bank is a little higher allocated toward loans, or at least kind of on the high end of the average range. And those loans are yielding pretty good yield, and so they've got a pretty good interest income here. On the interest expense, we've got about 2.5%, which is a little bit on the high side, but not too far out either. So deposits are yielding about 2.15%. That's probably pretty average, maybe a little bit on the high end, at least compared to last year when the yields were a lot lower. So we can tell that they're having to spend a little bit more on the liability side of the balance sheet. Anyway, so those two things together get us about 28 million net interest income, and that's about 2.93% net interest margin, which is really good. We're usually looking for something around 3%, right? So they're doing a really good job on the net interest income, a little bit higher than average interest income and offset by a little bit higher than average interest expense. But those two things together get some pretty average net interest income. So that's fantastic. And then coming down to the provisions, seem to be a little bit higher than it normally is. You can see the last quarter or the same quarter last year was about 600,000, and then this year it's all of a sudden 2 million, or this quarter it's all of a sudden 2 million, and that works out to almost 0.3% of the loans, which is a lot. So that's probably eaten a little bit into the net interest income. And then yeah, so it'll be interesting to see the credit quality as well, to find out why it is they needed to record a little bit more than is typical. I mean, most of the banks are in the range of somewhere between 0.10 and 0.2% of loans that they record as a provision, at least over the past year or so. So this one being almost 0.3% is a little bit higher than normal. So coming down to the non-interest income, that's about 8.5 million, and that's about 15% of revenue. So that's pretty good. It's really good. We typically see somewhere between 10 and 13%, so 15% of revenue. That's really great non-interest income, and that's because they've got some wealth management here. I believe they also have an insurance company that they get commissions from, so they do a good job of earning a lot of ancillary fees for various services, so making good money there. And then for the non-interest expense, we've got about 28 million, and that represents about 47% of revenue, which is that's on the high side. We typically see somewhere between about 41 and 47%. So 47% is what they have here. And yeah, it's a little bit high. I'm not really sure what's causing it to be high. Perhaps we can see when we get to the MD&A what might be an unusual amount. But so all that together puts us at a net income of about 6.4 million, and that's a return on assets of 0.66%. So that's low. We typically see somewhere between 0.8 and 1.05%. So this is 0.66%. And man, I was really hopeful with the net interest income being pretty average, and then they had a pretty good non-interest income. But then at the end of the day, the non-interest expense sort of takes a lot of that away and doesn't leave much left, or it at least puts them in return on assets that's lower than most banks currently. So I wonder what this efficiency ratio is. Yeah, so the efficiency ratio is about 75%. That's higher than the average banks. We typically see somewhere between 60-68% efficiency ratio. So the efficiency ratio is the non-interest expense divided by the revenue, with a few adjustments in there. But I mean, 75% is a really high efficiency ratio. That's not good. It's really unfortunate. I was getting excited about the profitability of the bank, but if we compare the earnings to the stock price, so we've got about 6.4 million here, and the market cap is about 250 million. So that ratio is about 10.5% earnings yield. So that's a pretty good price on the earnings, and you know, we typically see somewhere between 9 and 11% on the earnings yield. So, you know, 10.5% is really good. So, you know, even though the earnings might be lower than the average bank, the stock price is also lower than the average bank, or makes it to where a lower earnings is okay, somewhat, where we're paying the average price on these earnings that we would for the average bank. So yeah, it'll be interesting to see if what the risks are related to this, and it could possibly make sense that if the risks are all muted or reasonable, it might be okay to pay this price for these earnings, because it's a relatively cheap price for these earnings. But so let's keep digging in, and perhaps we can learn a bit more about the bank and decide whether it would be a good buy or not. Yep, so we see they're based in Ohio. They've got several ancillary subsidiaries here: investments, insurance, and the name of the bank they own is Civista Bank, located in Ohio, Indiana, and Kentucky. They've got a leasing division as well, so a lot of excess non-interest income that they can be making out of this, so that's fantastic. All right, so the security. So it's interesting, the allocation is a little bit different than what we might see from most banks. Mortgage-backed securities are only about 205 million, so about 33% of the securities portfolio. And then we've got about 11% of it is treasuries, but the bulk of it is munis here. So munis carry a little bit of risk, right? But and then the treasuries and the mortgage-backed securities are implicitly or explicitly riskless, but the bulk of their securities portfolio could have some credit risk there. So hopefully they speak a little to that once we get to that place. But we can also see the timing of the duration term structure of their securities portfolio, and we can see most of it is after 10 years. So that'll enter into our analysis of the interest rate risk when we get to that part. But most of it's the mortgage-backed securities as well on the back end, because typically they mature or can be prepaid, right? So there's sort of not a maturity for the securities themselves. So they don't mention an allowance for credit losses on the securities here. They basically just say that the unrealized losses are due to changes in market interest rates instead of credit quality. So, which is basically the boilerplate language that every bank has in their financial statements, right? So hopefully they tell a little bit more about the munis once we get to the MD and A. But now we've got the loans. We can see here that the commercial real estate is the largest allocation. It comes to about $1.5 billion, which is 53% of the loan portfolio. It's a little bit higher than we normally see. We typically somewhere between 33 and 42% is the average range that we see. So a little bit more allocated toward commercial real estate, about an average amount of residential loans, and then a little bit less C&I. This $302 million. So, they're a little bit more allocated toward commercial real estate and a little less toward business, C&I type loans. So really, it seems like their loan portfolio is about average for yields, but possibly also credit risk, although commercial real estate is the hot topic lately for credit risk, especially the ones that are non-owner occupied, which is what they mostly have. So it'll be interesting to see if there are a lot of non-accruals, past dues, that type of thing related to the non-owner occupied. So let's go see if that's the case. So I've got their allowance for loan losses here. It's about $38.8 million. And that's about 1.34%. That's pretty good. We typically see about 1.10 to 1.3%. So they're being outside the range that we typically see. 1.34% means that perhaps they have a larger reserve than most banks, and they're fairly conservative with it, right? So yeah, so here they tell a little bit about where they had to have a higher reserve than normal. It looks like there were 3 credits that required them to increase the allowance here, so that made them have a little bit higher credit risk. So, this is the danger that we're trying to avoid when we're analyzing this for all of our banks, right? Because there's the risk that, just 3 loans could all of a sudden hit us for $2 million in a bank, right? So we really try to do a good job of seeing, how many are the classified loans and how many are the past dues and the non-accruals, so that we can try to prevent big hits like this to our income statement. Because ultimately we're buying the banks for the earnings, right? So we want to make sure that when we're analyzing the earnings, we can reasonably predict that they will continue either the same going forward or increase, right? So we can get into the classified loans here. So those are basically the ones that are substandard or worse. It's where they have an identified weakness that would make it to where it's more likely that they will not be paid back in full, or that the collateral in place will not cover the entire loan. So we can add all these up, and it comes to $19.1 million. So that's a really, really low amount. That is about 0.66% of loans. We typically, for the classified loans, we typically see somewhere between 1.10 and 1.65%. So they're having a 0.66% is really, really low, and means that perhaps their credit quality is fairly robust compared to that of most banks. And interestingly, the commercial real estate part, only about 0.52% of the CRE loans are classified. So that's a really low amount as well. And that's interesting to think about, even especially because most of the CRE they have is non-owner occupied, which is presumably the higher risk loans, right? So maybe we can see how the past dues and non-accruals are doing, and see if maybe that makes sense that the classified loans are so low. We can see the past dues are 16 million, and that's pretty average, if not on the low end. It's about 0.56% of loans, so that's pretty low. You can also see the non-accruals, 13 million. That's about 0.46%. That's pretty average as well. And then we've got the collateral dependent loans here. Those are about 0.37%, so that's very average as well. And if we wanted to calculate the non-performing loans, it would basically be the OREO, but it says there's none, plus the non-accruals, which were 13, plus the 90 days past due and still accruing, which was 2.5. So that puts the non-performing loans at about 15.7, and that's 0.54% of assets, which is pretty average as well. So it looks like the credit quality itself is of the loan portfolio is very robust, where there's not any an average amount of non-performing, average amount of past dues. Classifieds are below what we typically see for the average bank, and then on the flip side, the reserve that they have in place is larger than normal. So we typically compare the reserve to the amount of classifieds to the amount of past dues, non-performing, and all of those ratios end up being either average or better than the average bank. So I feel like that they've been very conservative with their reserve, and we don't have a risk perhaps that higher provision might need to hit the balance sheet or the income statement at some point that would really negatively affect the earnings. So I feel really good about the credit risk. So they're not really detailed about the types of loans that they have in place. They basically just say they've got Fed funds purchased, securities sold, short-term borrowings. So I had to kind of look through the 10K, but also some of the other comments in the MD&A to put together. This is pretty much FHLB borrowing. And they don't mention it here either, but they have, I think, about 117 million of trust preferred securities. So if we look at the balance sheet, so FHLB, subordinated debentures, these are the the trust preferred securities, I believe. And then I'm not sure what the other borrowings are. Either way, it's not as much as the FHLB. Anyway, so the descriptions of the borrowings and stuff is not as robust as what we might see for most banks, but that's okay. When we get to the MD&A, we'll be able to see what some of the yields are, and when we get into the interest rate risk, we'll be able to see the timing of the repricing and such, so we'll know an idea of the maturities and that type of stuff. So we just sort of have to work a little bit harder to dig out the information. Pretty average amount of commitments here, about 740 million, about 26%, so that's good. And we looked at the stock-based comp as well, about 91,000 shares that could vest. with about $1.5 million of compensation expense that could hit the income statement as well. And those don't amount to a whole lot. I mean, 91,000 shares out of 15 million shares is less than 1%. So that doesn't dilute a shareholder's amount of earnings allocation or anything significantly. The 1.5 is about 4% of compensation expense, and that's about average as well. Most banks somewhere between 4 and 7%. So not an egregious amount of stock-based comp. Now we get to the fair value adjustments. So we typically adjust from the carrying value to the fair value. Carrying amount being what's on the balance sheet and basically what the price to book ratio is, right? And so we convert this to the fair value so that we can, more appropriately compare banks to other banks at the true fair value estimate. And so what we have, they don't have any held to maturity securities, so there's nothing to adjust there, but the loans go down by about, it's like maybe 120 million. Yeah, 120 million, which represents about 33% of equity. So the net assets go down by about 33% when converting from what's on the balance sheet to what their true value estimate is. So if we subtracted the fair value of assets minus the fair value of liabilities, it gets a sort of a net assets at fair value amount. And we can then compare that to the stock price, right? So another thing that we do is we take out the goodwill and the intangibles. That gives us sort of a tangible fair value of net assets. And when we do all that, it comes to about 114 million. So the tangible fair value net assets in the bank is about 114 million. But its stock price, or the market cap of the bank, is 245 million, right? So that means that we would have to pay a little over 2 times the tangible fair value of its net assets if we were to buy the bank, which is within a normal range. I mean, we typically see somewhere between 1.5 to 2.5, but so the 2.16 is the ratio or the multiplier, which is a little bit higher than what we've been seeing for a lot of banks over the past two or 3 weeks. A lot of banks have been in the ones, so the 2.16 is a little higher than what we've been seeing very recently, but it's within an average range. So, and even when we see banks that acquire other banks, it's usually around 2 times that they pay for the fair value of their net assets. So 2 times isn't that unusual. It seems like a lot, especially when you see the price to book ratio was 0.66 or something. Yeah, 0.66. But truly, when you convert everything to fair value, you're paying over 2 times for those net assets. So the price to book is technically a little over 2 times. So there could be circumstances where that makes sense to pay that, if it's the bank's making good money or the risks are muted and all that. But in this case, the bank isn't necessarily making good money. We haven't been through all the risks just yet, but it seems like 2 times would be, or a little over 2 times would be a little bit high of a price. Of course, let's keep going and see if we can get some more information about the risk and the earnings. But another thing that we look at is that tangible fair value, the 114 million, and compare it to the tangible fair value of its assets, which is about 3.5 billion, and that gets us a ratio of about 3%, and that's really, really low. That's probably one of the lowest that we've seen over the past 2 or 3 weeks of banks that we've been looking at. So that's sort of a gauge for capital adequacy, right? So it's sort of a common equity ratio, but at fair value rather than balance sheet value, right? So most of the banks that we have are somewhere between 5 and 7% for this ratio, but this bank is about 3%. So that leads me to believe that more than likely that there might be a capital adequacy issue. Although when you look at the balance sheet and you compare assets to equity, it's about 10 times, which is a normal average amount for a bank. So, but when you convert things to fair value, it paints a very different picture for the bank's price, but also for the capital adequacy. I think it's mostly due to the bank having more goodwill than most banks do, which we saw the goodwill was a little over 3%, while most banks usually have about 1% of goodwill. So we consider goodwill to be kind of dead assets, right? You're not earning a yield on it. It's not making you any money. Presumably, when you acquired the other banks and recorded goodwill, you had some kind of synergy or some kind of value that you were paying for. But if that doesn't happen, if that happens, the bank should earn more money, right? But it seems like maybe that didn't happen for this bank, unfortunately. So, and I don't necessarily remember or know the history of all the acquisitions that it's made, but it could be the case that they overpaid for them and didn't earn the yield or the return that they were hoping out of the synergies with the new bank. But anyway, so now it paints a price and a capital position that are less favorable than the average bank. I think mostly because they've got a little bit more goodwill than most banks. Anyway, so coming down, and we'll talk a little bit more about that once we kind of get into those parts of the MD&A. But so as far as the derivatives go, they don't have any hedges. They're all back-to-back derivatives where they do some kind of a swap with the customer, but then do the exact opposite swap with another counterparty. So they basically offset each other. So it doesn't really have an effect on the income statement or the balance sheet. So because one side will have a fair value of assets and the other side fair value of liabilities, right? Yeah, so asset of 14.7, liability of 14.7. So we really don't have that much of a concern for these types of transactions. And they don't have any cash flow hedges or fair value hedges either. So those would enter into our calculations for interest rate repricing risk. But since they don't have any, then we don't really need to delve deep into that. So now we're finally into the MD&A. So I really liked the loan quality, so maybe nothing to explore too deeply in there. So the uninsured deposit's about 447 million. That's a really low amount. It's about 15% of deposits, and so we typically see somewhere between 30-35%, so a really low amount of uninsured deposits, which is great. So now we can see a little bit of the operations. They had, for the interest earning assets, they had 5.64% yield. That's pretty good. Really good loan yield, also a reasonable securities yield currently. And then on the interest expense side, time deposits seem really, really expensive, 5.33%, basically more than the cost of the FHLB advances. So it's probably digging into their net income for the year. It's interesting, the subordinated debentures, which I'm assuming are the trust preferred securities, it seems like that they should have a lot higher yield. I would imagine they're floating rates. So a lot of banks were seeing somewhere between 8-9% yields on those types of securities. So I'm not sure why it's so cheap. But yeah, I mean, the time deposits seem to be really expensive. Demand and savings deposits are pretty cheap. That's a good yield. But the FHLB advances, time deposits cutting into about 5% yield, so that makes the interest expense for all the interest-bearing liabilities to be pretty high. I mean, not that unusual. We're seeing a lot of that over the past 2 or 3 weeks being at that yield, but definitely compared to over the last year, that's a pretty high amount. But that puts us at a net interest margin of about 3.22%, which is fantastic. We typically see something between 3 and 3.5%, so they're making really good money on the net interest income. They're making a good interest income, and then interest expense is a little bit higher as well, but those two together gives them a pretty good average net interest margin, which is fantastic. I guess the net interest margins come down from last quarter, but last quarter it was such a high margin that it's not putting them into a low net interest margin now. There's been a lot of banks that started last year at around 3.25%, and now they're in the twos, right? But this bank started at 4%, and now they're in the threes, so it's fantastic. All right, so now we're down into the non-interest income. It looks like in the last quarter it was 11 million, and this quarter 8.5 million. So it's down 2.5 million. That's a lot, 23%. So it could be part of why they are a bit less profitable than average now, and a lot of it's that they closed down the tax refund processing business. Yeah, it says they exited this line of business, so that takes out a couple million from a quarter, and that could possibly be a seasonality thing as well. So we really can't, if we were looking at this as this 1.9 might not be a good metric for annualizing or multiplying by 4 to get to the year, but could potentially be a lot of revenue for the year that's lost by not having that tax refund business. Like if we multiplied this by 4, it'd be $8 million. And if most of the revenue happens in the second quarter, then this is smaller than perhaps what could potentially be made for the year. So we'd have to look at the second quarter and see how that looks, and maybe the third quarter. But it does seem like that part of the reason that they might not be making as much money now is that they have eliminated that line of business. But the non-interest expense is pretty much the same as last quarter. This is the area that we saw as being more expensive than the average bank, so it'll be interesting to see if there's anything we can identify that's making it unusually expensive. And by looking at the occupancy and equipment as well as the compensation, most banks are within a particular range of revenue, and this bank is a little bit on the high end for all these, for their compensation, occupancy, and equipment compared to other banks when we compare to revenue. So those are kind of the drivers, I think. And software maintenance expense seems to be, spend over $1 million maintaining their software. So it looks like they say that the salaries the compensation is higher than last year due to increased salaries, payroll tax, employee insurance, which isn't that unusual lately as inflation's caused salaries and stuff to increase. So, it's not that unusual. Yeah, so there's nothing really that we can hang our hat on as being something that's, unusual or different, or one time that we could take out of the earnings perhaps to normalize it, right? So that's unfortunate, but it does just seem that the costs that they're paying for their compensation, occupancy, and equipment is higher than what the average bank is, and it's causing them to have a little bit higher non-interest expense, and that's hurting their efficiency ratio as well as the overall net income of the bank, as well as doing away with the tax processing fees, which might have added a significant amount of revenue to the company. So not sure why they did away with it, but it's definitely taking out from the revenue which they might have been making in the past, although we did see that they are making pretty good non-interest income, right, with the wealth management and insurance. So maybe it's not that big of a problem, but in conjunction with the higher non-interest expense, it eats into the net income. So now we're down into the capital resources and liquidity. So those things kind of go hand in hand. So maybe we can look at them together. We can see that the ratios here, leverage ratio 8.6%, the common equity tier 1 9.8, 10.8, 14.5. So these ratios are really, really low compared to most banks, and they're within the required threshold for compliance regulatory purposes, but when you compare these to other banks, they're a little bit lower than what other banks are, and maybe that's related to what we were talking about, where converting things to fair value puts them at less of a capital adequacy position. And looking at the common equity ratios, basically just from the balance sheet perspective, the tangible common equity is about 6.25%, which is really, really low. We typically see 7.5 to almost 9%. So 6.25 is pretty low tangible common equity ratio, and it's a result of having a larger amount of goodwill on their books, probably, because the common equity ratio is about 9.5%, not taking into account not taking out the intangibles, right? So, and it's an average amount, so 9 to 10.5% is the average. So this bank having 9.5% makes it pretty average, but when you pull out the goodwill and the intangibles, it puts them at have a smaller tangible common equity ratio, and we saw that also when we converted things to fair value. So it seems like perhaps the capital position might not be adequate, but let's look at the liquidity and then kind of circle back and look at them together. So from what we looked at earlier, they had about $50 million of cash, which is below what we would typically see, and they had an average amount of securities, and and then only about 34% of the securities are pledged. So that means that the on-balance sheet liquidity is about $450 million, and that's about 15% of deposits, which is a really good ratio. So we typically see somewhere between 13 and 18%. So they've got about 15% of deposits on the balance sheet in liquid assets. So that makes me feel really good about their liquidity. I feel like they're fairly liquid, and they also have the ability to borrow from other correspondent banks as well as from the FHLB. I mean, when you add this $50 million that they can borrow, as well as $445 million that they can borrow from the FHLB, and then $15 million from another correspondent bank, that totals up to a little over $500 million that they could borrow in addition to what is liquid on their balance sheet currently. And then also taking into account, additional assets that they could pledge, or, for example, securities or loans that they haven't pledged just yet, makes it to where they have access to about $1.6 billion probably. And that's about 53% of deposits, which is a really low amount as well. So we typically see somewhere between 70 and 80% of deposits for on-balance sheet plus off-balance sheet liquidity, but these guys only have 53% in our calculation estimates. So that puts them in a place to where maybe their capital isn't as adequate as the average bank. And we saw that converting things to fair value. We saw that in looking at the regulatory ratios, the normal common equity, tangible common equity ratios, those sorts of things. So it appears like maybe they don't have as much capital as the average bank, and so we might have to ding them for capital risk. But the liquidity is great, right? They have a substantial amount of unencumbered securities that could be used to get cash almost immediately. So, and then we've got the market risk here, which tells us a little bit about the interest rate repricing risk. We can see from this, it appears to be a little more leaning toward the asset sensitive side. Actually, this is a little bit different than what we typically use. This is the net portfolio value, so it's looking at something different than we normally compare this to the net interest income, but they don't really have a table explaining what would happen to their net interest income, unless it's more of a discussion up here. No, this is all basically just boilerplate language. Yeah, so fortunately we do our own calculations related to this, looking at the call report, so we can see the timing of the repricing of the assets and liabilities, right, and make our own calculations as far as the repricing risk. And by looking at the securities, as is typically the case, most all of them reprice after 5 years from now. We're more looking in this analysis for what does our repricing risk look like over the next year. So we want to see, when do the securities reprice within the next year? How much of the loans reprice in the next year? How much of the deposits reprice in the next year? How much of the debt reprices in the next year? And compare to see, what's the difference between the assets that reprice and the liabilities that reprice, and how would that affect our net interest income, right? And then for the loans, we have about 30% of them reprice within the next year, so that's pretty average. We usually see somewhere between 25 and 35% reprice, so they have a pretty average repricing timing of their loan portfolio. And then on the deposit side, we take the normal core deposits and add in the time deposits that reprice within the next year. And so those three things combined is about 75% of the deposits that reprice within the next year. And so that's a little bit on the high end. So, and then the debt, almost 100% of the debt reprices within the next year. And that's about $500 million. So when we add all those things together, basically none of the securities reprice in the next year. So aside from this interest rate repricing risk, that seems to me a risk for liquidity purposes as well, because I think when we were looking at the liquidity, they don't have any cash hardly, and so we were hanging our hat on the securities as being the source of liquidity, but it looks like none of them reprice within the next year. Of course, they could sell them or borrow against them, right? So maybe that's the plan, but they have no securities that reprice within the next year. The loans have about an average amount that reprice, and then a high amount of deposits reprice within the next year, and then all the debt, right? So and they have no derivatives that would counteract any types of mismatches in asset liability. So it seems like they might be a little bit liability sensitive, and that's apparent from, or at least they were over the past year, because we can see that the net interest margin went down, right? So I feel like that there's a risk that as interest rates go up, or in the market, the interest rates are higher than what they've been on this in these financial statements, right? So when the liabilities reprice to those higher rates, and also customers are demanding higher yields on their deposit accounts, stuff like that, they're going to have to be paying higher interest expense. Meanwhile, the securities are sort of locked in for a while at the 3.5% yield, right? And then only about 30% of the loans reprice. But so those two together, I think, could potentially squeeze the net interest margin, which would make and that's what that was the great part of the bank, right, was the net interest margin. So, squeezing the net interest margin would make their net income be even lower than what it is, and with the higher amount of non-interest expense, not helping as well. So that's the risk that we enter into with banks in general, but especially this one that would be perhaps or potentially a little more liability sensitive. Another thing that we look at is comparing last year's balance sheet to this year's balance sheet for just the interest bearing assets and liabilities. And we look at, well, how has the structure of interest earning assets compared to interest bearing liabilities? Have they increased interest earning assets compared to interest bearing liabilities? And that would basically widen their net interest income. Or has that decreased, where they've increased interest bearing liabilities more than the interest earning assets increased? And so that would make their interest expense go up more than interest income, right? And so with this bank, we've seen that this ratio of the change in interest earning assets compared to interest bearing liabilities has gone down, which means that they've added more interest bearing liabilities than interest earning assets, which should decrease their net interest income as well. So, wow, that was tough to explain. But yeah, I think you guys get it. So I think that the interest risk is a little bit higher than what I would prefer. Another thing to mention that I didn't really have a place to say it until now is that they've got a lot more brokered deposits than what we would normally see. They have about 18% of their deposits are brokered, and that might be why when we were looking at the yields, their time deposits seem to be such a high yield. I think did we remember that the time deposits were yielding more than the FHLB advances? So maybe they're having so many broker deposits is what's causing that. So anyway, so I think that is everything. They do have a share repurchase program authorized. That's about $12 million that they can purchase. So if you divide that by the stock price, that's about 0.77 shares, so about 5% of the shares outstanding. So they could be repurchasing about 5% of the shares. That would be cool. Anyway, so here's the bottom of the thing, and we can maybe summarize what we talked about and what our conclusion is. We saw the bank is a little bit less profitable than what the average bank is. I believe it had about a 0.66% return on assets, which is pretty low. Normally see somewhere between 8 to 1%. So, a lot of it's due to the non-interest expense being higher than the average bank, and it looked like it would kind of boil down to the compensation and equipment, and occupancy seemed to be a little bit higher than what the average bank has, or at least sort of on the high end. And that ate into the net interest. They had a really good net interest income, but that non-interest expense really ate into it and makes them to be a lower profitability bank than average. The saving grace was that the stock price was low enough to make it to where an earnings yield seemed to be it seemed to be a pretty good average earnings yield, about 10.5%. So even though the bank was less profitable, you could perhaps buy the bank at a cheap enough price to make that earnings yield worthwhile, right? But then we started digging into the risks, and first the interest rate risk. Interest repricing risk seemed a little bit too high. We compared the timing of repricing of the assets to the liabilities, and we saw that none of the securities repriced within the next year, and probably an average amount of loans repriced within the next year. But there was a higher amount of deposits that reprice in the next year, as well as all the debt reprices next year practically. I think there was maybe 1 or 2% of it that doesn't. So that puts us in a position to where we're really, really liability sensitive, I think. And they don't have any derivatives to perhaps fix some of the liability pricing, which, given that they've got such a large amount of broker deposits, they probably should fix those prices at least, or those yields at least. But I feel like they're in a liability sensitive position that might decrease their net interest income, which was the good part of their income statement, right? So I feel like that risk there is too high. In addition, the capital risk, I felt like the amount of capital that they have in equity is not as much as what the average bank has. And when we converted their assets and liabilities to fair value, we saw that as a percentage of assets, which would be sort of a common equity ratio, but at fair value, puts them at a really low ratio compared to other banks, especially if we take out the goodwill and intangibles and puts them into a tangible net asset value figure. It puts the bank at a really low capital adequacy ratio compared to what we might see for most banks. And we also saw regulatory ratios were really low compared to other banks. They're not necessarily in a range to where they're below the regulatory required thresholds, but they are in a position to where it's not as high as other banks are. And they had really great liquidity, on balance sheet liquidity, but whenever we take into account potential off balance sheet liquidity, it's not as much as what the average bank might have, and that might be due to not having as much capital in place that they could pledge, right? So anyway, we felt like the capital was not as adequate as what the average bank was, so we're going to ding them for that as well. The good thing about the bank is that I feel like they have really good robust credit quality. Not only were their past dues, non-accruals, classifieds were pretty low amounts relative to the total loan portfolio, but they also had a reserve that was a lot higher than what most banks have in place as a percentage of loans. So I feel like they've been really conservative in creating an appropriate reserve for their loan portfolio. They did have to take a hit to their income statement this quarter for 3 credits that they had to allow for, but now I feel like that the reserve they have in place is robust and conservative, at least relative to other banks. So that's good. So all that together, earnings weren't as good. The interest repricing risk wasn't good. Capital adequacy not good, and but they do have good loan credit quality. So based on putting all that together and then comparing it to the market price, we can see that the price earnings ratio, or the earnings yield, comes into about an average amount and so we would want if we were going to pay an average price for those earnings, we would want an average risk, and have a relatively reasonable expectation that those earnings are going to continue into the future. But what we have with the interest rate risk, as well as the capital risk, is that there could be a reasonable chance that the earnings have to decrease at some point in the future. And so for that, we would want the bank to be at a cheaper price to make it to where we could earn a higher earnings yield to protect us against the case that perhaps the earnings are going down, right? And I think in this case, we don't have a low enough stock price to make us earn enough to make us comfortable given these risks. Anyway, so that's my analysis and conclusion on the thing. So it's basically a no-go for us at this time. When we look at it again next year, hopefully maybe the non-interest expense is a little bit lower, and some of the risks that we talked about have been muted or corrected, and we'll have a better chance at having a good buy here. But as it is now, I don't think we're going to pull the trigger on this one. So, let me know in the comments if there's anything I missed or was confusing, or, I was wrong or I was right, or whatever. I'd love to hear what you have to say, and, definitely do your own research, and, don't, rely on what I'm saying for your investment decisions. Definitely do your own thought process and make sure I'm on the right track. This is the way I approach things for my own personal and for our clients' portfolios, and your personal situation might be different, right? So anyway, thank you for listening, and see you for the next one.